So to continue the exercise of yesterday lecture, so maybe we can start with question 3. So, but before that, before I start to discuss about question 3, I'll give you some time that you read the question first. So we're going to do this question 3. So at the same time, I summarize. So question is saying that a moderately risk-averse investor has 50% of their portfolio invested in stocks and 50% is in risk-free treasury bills. So it means that, do you remember what was being yesterday's session? We were saying that the amount of our income that we intend to do to invest in the stock market. So now you can see that here. Of course, B and 1 minus B is equal. So that's why I put B is equal to 0.5. Then show that each of the following events and show that how each of the following events will affect the investor budget line. So if you remember, we discussed about this budget line yesterday and the proportion of stock in the portfolio. Okay. My friends, do remember that you have to read the questions very carefully. Okay, so what the question wants first, the question wants about the budget line, and then it wants about the proportion of the stock in the portfolio. It means that we read these two scenarios, and then we have to discuss that whether this investor is going to buy more stock or less stock. So it means that the final conclusion that we have to say is that we have to say that whether this person is buying more stock or less stock. So now the scenarios. The first scenario is that the expected return on a stock market is increasing. So what was the expected return on the stock market? It was RM. So it means that RM is increasing. And a standard deviation of a stock market remains the same. Standard deviation, it means that the risk of the stock market. So the risk of the stock market, it was sigma M. So sigma M is remaining the same. So now 2 parts we have to answer. First, we have to answer what will happen to the investor budget line, and then we have to answer that what will happen to the proportion of the stock in the portfolio. Are we buying more stock or less stock? The first part is such an easy question, and this kind of easy question you're going to have one in the final. So this is what I have summarized, that B is 0.5. Then I have summarized that risk in the stock market is going to remain the same. So that's why I have put sigma M is the same. And the return of the stock market is going to increase. So now we want to discuss about budget line. So can you help me to write the formula of budget line? You remember what was that? So basically, we want to draw this graph that here is sigma M. Sorry, here is sigma P. Means that the risk of the portfolio, even here is the return on the portfolio. And we want to discuss about the return on the portfolio is equal to RF. This is the formula that I asked you that you have to memorize. So this is the only thing you memorize in this whole module. So it means that the risk and the return on risk-free asset, that is going to be the intercept of the function plus, so we're going to have the slope, and then here we're going to have the risk on portfolio. And then what was the slope? The slope was RM minus RF divided by, sigma. So now RM has increased. So how many times we have RM here? We have only 1 time RM here. So it means that When Rm is increasing, it means that the slope of the function increases. So if I want to draw these two scenarios, it means that first, this is the first scenario. So I say budget line in scenario 1. So here is RF. And in the second scenario, okay, in the second scenario, risk on the stock market has increased. So that's why we know that the slope of the function will be moved. So that's why. And then how about this RF? RF has remained unchanged. So that's why the slope, the intercept is the same, just the slope is increased. So we say that the budget line is pivoting. So do we call this shift? No, we don't call it shift. Do remember that whenever we want to talk about a shift, shift is like this, that for example, you have a graph. From here, you will move upward or downward. So here is called shift. But when the intercept is remaining the same and it's rotating, so that's why we say that the graph is pivoting or rotating. So fine, so this is the slope of the function. So the first part that the function wants us about the slope, that yes, the slope has changed. The second part is saying that tell us that what will be the proportion of the stock in portfolio. So are we buying portfolio? So are we buying more stock or less stock? The return on the stock has increased and the risk is the same. So of course, it makes more sense to buy more stock. Why? Because now with the same amount of the risk, so we are able to earn more. So that's why we buy more stock and therefore the proportion of the stock in the portfolio will increase. So far, it's right. It doesn't need more justification. When we will have a bit of more justification, who can tell me? For example, when Rm is increasing or sigma m is increasing, since we have them in the slope, so easily we know that the slope of the function will change, either pivoting left or pivoting right. But how about if this is going to change Rf? Because we have Rf both in the intercept and then we have it in the slope as well. And that's what the question is asking in the second part. The second part is saying that, so we're done with it. We're done with the first part. So part 2, this is part A. So it's saying that the return on risk-free treasury bills decreases. So it means that RF is decreasing. So to make it a bit more easier, you do the decrease yourself. So I do it increase first. Increase. Of course, it does not make any sense, but since increase, understanding it with increase is easier, so I use increase. For the decrease, you're gonna make everything vice versa, but since understanding of it takes a bit of time, so I prefer to go with increase. So overall, it's saying that RF is going to increase. So now that RF is increasing, let's see that what we have to do. Listen this part very carefully. I will ask a question, you answer my question. First, the return on here, let's say that I want to discuss the increase. So it means that the return on risk-free asset is increased. If we want to discuss about the slope of the function, so look at the slope of the function. So it means that here, if this is increasing, so it means that we are making Rm minus something bigger. Minus something bigger means that overall it makes the denominator smaller. So that's why I will write it here that once RF is increasing, it means that we are Rm minus something bigger. So the overall result will be smaller. So that's why we say Rm minus RF will be less. And once it is less, it means that what will happen to the slope of the function? the slope of the function will become less. Will become less steep. Okay. But apart from this RF, we have another RF here. So it means that apart having the RF in the slope, we have it in the intercept as well. So what will happen in the intercept of the function? So intercept of the function will increase. Intercept will increase. If I want to discuss from the previous scenario, so in the previous scenario, once we take some fixed amount of risk, for example, like here. So we take this risk, we want to know that how much is the return. You see that now initially the return is with the same amount of the risk return is here. Then after the budget line is pivoting with the same amount of risk. So we can see that the return is increasing, right? So the budget line is showing that exactly like what we have discussed and the question is telling us. So with the same amount of the risk, now the return is graph is exactly consistent with the question itself. Now we want to draw this and we want to know that how it looks. I close the aircon, I feel hot. I open the aircon, I feel cold. We have the same issue. So this is BL1. And then RF is increasing, means that this is RF1, this is RF2, and then the budget line, it will be less steep. So currently BL2. So now the complication will appear here. How the complication is coming that, let's say that if we are here, if we take at this level of risk. So at this level, in the new budget line, we have higher risk, we have higher return, right? If we take this part of the risk, so then we can say that at previous budget line, we had more return compared to new budget line. So that's why we don't know that whether we are buying finally what is the answer. So it means that I summarize it here. So let's say that in the position one, here is the position one, I put one, right? So with increase in RF, higher return is gained. Then in position two, with increase in RF here, so less return will be gained. So it's kind of confusing that finally, I mean, are we getting more return or are we getting less return? And then even we can discuss it from another aspect as well. I can draw one more return on P, and then here is the sigma P. So here is BL1, and then here is BL2. Okay, so now let's say that if we want to take the same amount of return, let's say that we are here. So you can see that if we are here, so again, a kind of contradiction is happening. that, that with same amount of risk, it is possible that the new scenario is giving us more risk. Or if we are here, or for example, let's say that here, we're here. So it means that this amount of return, for example, is giving us, again, you can see it's a very small change, but it is possible that this amount of return in the second scenario, is giving us more risk. So again, I repeat that if I am here, I put it 1 star. So if I am in 1 star position, so this is risk, and this one is also risk 1, risk 2 in the star position. So in the star, if I am here in the bit increase in RF, you can see that the risk of the portfolio is increasing. So you can see that it's higher. Then it is possible that I am somewhere here. For example, let's say that here. That with new portfolio, you can see from here, I come until I reach to the boat line. So with this amount at this position, so you can see that the new portfolio is giving me less risk. So it means that this is double star. So it means that this is again, which one is new? Yeah, this one is new. I put it 2, and this one is old. I put it 1. So again, what I'm trying my best to say is that we don't understand that finally, when RF is increasing, so are we gaining more or are we gaining less? And we are saying that if RF is increasing, are we having more risk or less risk? Because it really depends that what kind of portfolio we make. In the previous example, once RF was increasing, it doesn't matter that which kind of portfolio you are making. Anything you are making, it means that it makes more sense to buy more stock. But here, you don't know. If you want to judge based on, for example, higher return, it is possible that it totally depends that where are you, which kind of risk you want to take. It is possible that you're going to have the higher return. It is possible that you're going to have a less return. And again, if you want to assume that the return is fixed, again, with the new situation, it is possible that you're going to have higher risk, or it is possible that you're going to have less risk. So what I'm trying my best to say is that in this scenario, it is very important that what is my preference. What my preference is, that means that where do I stand? What kind of portfolio I want to make? So now I want to discuss about different kinds of portfolio that I want to, I have the option to make. First, it means that the first one is saying that RF is increasing. So just I have that preference that, okay, that's very good, because risk on risk-free asset increasing. So that's why I prefer that I increase my portion of T-bills. Why? Because the return of this is increasing. So that's why I increase my portion of T-bills. So I'm gonna buy more of T-bills. So once I buy more of T-bills, my budget is limited, right? So that's why it cannot be more of T-bills and more of stock. So once I'm buying more of T-bills, so it means that I have to specify less in the stock. So that's why it means that portion of the stock in the portfolio will be less. So is that clear so far? So this is one option, right? So one option is that RF is increasing, and what I'm trying to do is that I say, okay, the risk-free asset is increasing, so I want to buy more of it, because my risk can be remaining the same, or even my risk can be less. Why my risk can be less? Because easily I can transfer some money from the stock to the risk-free asset. I can buy more of T-bills. So once the portion of the stock in my portfolio will be less, so automatically my risk will be less. So this is the scenario that I was saying here. So we choose a kind of portfolio that with increase in R, our risk is less. So this is one scenario. Later on, I want you to link these scenarios to the theories. But anyway, let me complete first. The second scenario. The second scenario is that I say that, hey, I have a preference in my mind. So I write it very bold. I have a preference in my mind about the expected return on T-bills. So read this first. So in this scenario, I have something in my mind. What is that something? I say that as long as I earn A from the portfolio, from T-bills, I'm happy. I don't care that how much I'm going to buy. I'm saying that as long as I'm earning 8%, this is return. As long as I'm earning A, I don't care that how many T-bills, I'm happy. So my preference is fulfilled. So in this scenario, if I am following this mindset, so in this scenario, if RF is increasing, so what will you do with T-bills? Are you buying more T-bills or less? Once more, I repeat my question. Let's say that I have a particular preference in my mind. So it means that my preference is about what? My preference is about that I prefer to earn $1 billion or $8 from T-bills. As long as I earn $8, it's sufficient for me. I don't care that how many T-bills do I need. Just I buy that much of T-bills to make sure that I'm earning A. So now when return on the T-bills is increasing, are you buying more T-bills or less T-bills? So it means that I'm not able to transfer my message. You see that we have two scenarios. It is scenario one, before rise in RF. Before rise in RF, okay? So let's say that I am buying X number of T-bills multiplied by return on the T-bills, so I'm earning A. So this is before rise in RF. Now, second scenario, this is scenario one. Scenario two means that RF has risen. So now I have RF2, here is RF1. I have RF2, which is higher than this. And I know that I want exactly this amount here, 8%. And this is higher than this. So how many of this will you buy? Do you need to buy more or less? I care only about this. Just now I wrote that this is what is in my mind. This is in my mind that I want only $1. I don't care how much do I need to buy. I want this. As long as I earn this, it's fulfilled for me. So now RF has increased. It means that, yes, it means that I need less of this stock, less of T-bills. So that's why this X2 is less than X1. So X2 is less than X1. Why? Because we know that these two are the same. So once RF is increasing, so to make sure that this equation is remaining the same. So that's why the quantity of T-bills has to decrease. So that's why X2 is less than X1. This is the only difficult part that I was killing myself to understand. So once more, I repeat. So once RF is increasing, like here, two scenarios is happening. And I showed you in the graph that we don't know that whether finally the return is going to increase or decrease. So that is the reason that to answer the question, which is saying that the stock in the portfolio will increase or decrease, we say depends. We showed it in the graph, it really depends. So once you see that in one scenario, the risk is increasing, it means that the stock in the portfolio is increasing because we know that the stock are risky asset. So in this scenario that the risk in the second situation is increasing, it means that the portion of the stock has increased. In this scenario that the risk has decreased, it means that the portion of the stock has decreased. But here, it was only one answer. Here in this, it was only one answer. That with the same amount of the risk, of course, the return has increased. Here, we couldn't know. So now we want to explain that why we don't know. So it depends on the portfolio, it depends on our preference. So in the first scenario, I'm saying that once RF is increasing, so I am those category of people that I just look at this return. I say that, okay, as long as return, so it means that I care only for the return on this. So I say that as long as RF is increasing, fine, I'm happy. So I increase the T-bills. And my budget is limited. So once I want to buy more T-bills, it means that I have to transfer some money from the stock to T-bills market. So that's why portion of a stock in the portfolio will be less. So as long as portion of a stock in the portfolio will be less, it means that risk will be less. And this is that we are in that kind of portfolio that in the second scenario, this risk is less than risk in the earlier scenario. I have another group of people that those group of people, they have a particular preference in their mind. First category, they didn't have any preference. They were just caring about the return. Return or RF is increasing, return or risk-free assets is increasing, so they want to buy more. This group of people, they have preference in my mind. What is their preference? Their preference is about the total return on the asset. So I say that I have a preference about the total expected total return on T-bills on the asset. So once I have the total expectation about the asset, so it means that I know that I want to earn 8% or $8 of the return. So now that I want the $8, so I have to compare the return on the asset for the first and second scenario. In the second scenario, the return of the asset has increased. So it means that to earn whatever is in my mind, I need now less T-bills. So that justifies that the quantity of T-bills decreases. So once the quantity of T-bills means that I need less T-bills. So what I do, I transfer my money, transfer to stock market. I buy more stock. Once I buy more stock, it means that the risk on the portfolio is increasing. And that again justify that, just now I told you that it depends that how do we form our portfolio? How much of each one we want to buy and how much of return we aim to have. So if you aim to have higher return, you see here, yeah, you have to bear higher risk. If you want to have lower return, it is possible that your risk will decrease as well. So if it is clear, I want to ask a question. So the answer for the second part of the question is that whether the portion of the stock in the portfolio will increase or decrease, you say that it can go either way. It can increase, it can decrease. So if those people are the people who are only caring about the return on risk-free, about the total return, about the return on risk-free asset, so it means that those people, they prefer to buy more, and therefore the amount of the stock in the portfolio will be less, risk will be less. But some people, they have a particular preference in their mind that they prefer to have a total expected return on risk-free asset. So for those group of people, when RF is increasing, means that they need to buy less quantity of risk-free asset, and therefore they transfer the money to the stock market, and then the risk will increase. So is that clear? I want to ask a question. Then who has to answer my question? Let me see. Let me see. Who is here? Okay, who want to answer my question? Who is sleeping? I want to wake you up. Tae Kai Jun, are you here?
Yeah, I'm here.
Okay. So I want to ask a question. Do you want to open your camera?
No, not really. Not right now.
Okay.
Yeah.
Are you sitting with your girlfriend?
No, but it's not a good time.
Okay, you answer one question. We discussed about two scenarios, am I right?
Yeah.
The first scenario was that people were caring about only RF. As soon as they say RF is increasing, so they buy more of T-bills. The other group of people, they have a particular preference in their mind. Okay.
Okay.
If I want you to give two theories from the term structure of interest rate and relate to these two scenarios, what are the theories?
Oh shoot! Wait, let me look it up real quick.
Okay. Okay.
Give me a second.
Mm.
So you wanna look at the term structure of interest rates, right?
Yes. What were the theories? We had three theories, right?
Structure. The three theories are expectation theory, market segmentation theory, and liquidity premium theory.
Correct.
Yeah. So.
Okay. So the first scenario that the people were looking at RF, as long as RF is increasing, so they buy more of T-bills. So if you want to make a resemblance to the theories, which theory is the most suitable theory for that?
Maybe expectation, because yeah, they're interchangeable.
Because for the expectation theory, they were only caring about the return. As long as they don't care about the timing of the bond. As soon as they say that the return is higher, they go for that. Here is the thing. They don't care about anything. As long as RF is increasing, they go for that.
Okay.
And then about the second one?
Wait, what is the second one again?
The second one was that the people, they have a particular preference in their mind. So they don't care that whether they have to buy less or more. Just they care that they have to earn this particular amount.
Oh, so segmented market theory.
Yes. Thank you so much. Thank you.
Hey, you're welcome.
So guys, this is the way that I want you to learn the module, that you can link everything together, right? So now I'm sure that you understand that this is exactly the way and the participation that I expect in the class, that you can link everything. So it means that you have learned really the theories. So now that you have learned something, so I know that you're angry with me because of midterm, but let me, just take you to the midterm. So you remember one of the questions of the midterm was capital flight. So capital flight actually is another name for risk structure of interest rate. And what was the explanation in the article? And basically the explanation of risk structure, we say that risk structure, do you remember that we had two graphs? Always we had corporate bonds and we have treasury bonds. Then in the we say that, okay, the corporate is going to be risky. So that's why the people, they sell the bonds in the corporate and they come and they buy more of treasury bonds. You remember that, right? Flight to capital is exactly like that. That as soon as they feel that something is risky, they fly the capital to something which has more quality. So that's basically the intuition is the same, the concept is the same. Just what I did normally with the T-bills and corporate. In the exam, I change it. Instead of T-bills and corporate, I put it bond and stock market. And bond and the stock market is something that you every day in life, if you check the transaction in the Bursa Malaysia, you will see that. As soon as one stock of particular company or overall the stock market is this way, so a lot of people, they buy bond. As soon as the stock market is this way, those bond holders, they come to stock market. That's risk structure of the interest rate. So immediately the demand for one is increasing, the demand for another one is increasing. And that's why we say that this is flight to quality. It means that the capital will fly to find a better quality capital. So I'm sorry again to remind a very bad memory for you. If you notice, I even didn't dare to release the marks for you. I'm trying to put it on the curve to increase it a bit more. And then at the same time, waiting for your assignment to see that, okay, I adjust. So anyway, don't be angry. I try my best to help. Okay. So now you can get the linkage between concepts, right? So if you learn the concept, basically, then you can link whatever. If we change the name or we do everything, you are able to link them together. So we are done with only one question so far. So we go for one easy question, because this one normally in this question tree normally takes a bit of energy until I try my best to transfer the message to you. So I go for easy question. The easy question is like question 2. Exactly will be opposite. So whatever discussion, I leave it to you. You just do yourself the decrease, RF decreases, and then you come back to me if you couldn't justify. Okay. So it means that in one scenario, they say that, okay, RF is decreasing, so that's why we don't want it. So they definitely they shift to stock market. Then the another scenario, they say that, okay, RF is decreasing, so that's why we need more of T-bills. So, and then they bring money from stock market to T-bills. So it's exactly the same thing. Okay. Let's go, one easy question or no, okay. Let me do question 4. It's again easy, but maybe since I just taught yesterday, so maybe you have it in your mind, so it will be easier for you. Is that okay? I give you a bit of time. Maybe you want to have a try on this question 4. So maybe we can do it together. I need to write the summary of that for myself. So shall we do together? Agree? As is your working table like me, it's such a mess. Okay, so I just help you. I want you to do this time. So we use the utility function. First, you write the utility function. And the utility function is 10i. Then you say that assume that Sarah is currently earning the income was 40. Okay, Sarah's income is 40. And then can earn income with certainty over a chance. Okay, you're summarizing, am I right? Then she is offered a chance to take a new job with the probability of, so P1 is 0.6 and the earning, so it means that I1 is equal to 44,000 and the probability is 0.4 and then I2 is 33,000. Should she take a new job? So first, to answer the first part, what are we supposed to do? So maybe we can calculate, let's say that if we calculate the utility, confirm utility, and then we compare it with expected utility, that's one option. Let's do that. So can you calculate the expected utility, please? Tell me the number. Number for expected utility. So let me know if you have done it. Great. Yes, thank you. Yes, great job. And yeah, so what is your advice? Do you think that she has to take a job, take this position, take this gamble, let's say? Should not. Exactly. Okay, now that you are such a good student to me, can you please proceed to the next part? I want to say that whether you remember how to calculate the risk premium. Now you see that the answer for the question definitely means that it should not. because the second part is saying that let's say that for unexplained reason, Sarah decides to take the offer. So it means that it's obvious that the previous part of the answer is that she should not. So now let's say that, okay, if let's say that she takes the offer, then, and she has to, definitely she wants to buy the insurance, then say that how much is the risk premium. So it means that how much she will be willing to pay for the insurance. This insurance paying for the insurance means that risk premium. So do remember for the risk premium, what you are supposed to do. Do you remember from the class that first you were supposed to calculate the expected weight, right? And then we assume that the expected utility, we treat the expected utility exactly to confirm utility. It means that first we calculate the expected utility, then we give the expected utility to the utility function to calculate the level of income. Then the difference between this level of income with expected income is the risk premium. So see that whether you can calculate it or not. Has anybody calculated these? No, this is, I'm calculating part B. I just left it to you, so I thought that maybe I can do with you. Then later I do the whole thing. Have you calculated this part? The answer? Yeah, seems correct. Yeah. Okay, so first we calculate. Shall I start, guys? Any of you, have you got the risk premium number you want to share before I start? Exactly, yes, thank you, team. Yeah, so let's start from the first part. The first part of the question is saying that, yeah, it has given info and then say that whether the person has to take the job or not. So what was the scenario? The scenario is that she has a confirmed salary of 40,000, and then she is given two options as well. So it means that this is option one, this is one, and this is option two. In option two is 60% chance that she's earning this much and 40% chance that she's earning this much. So you want to know that whether she has to take the job or not. The first thing that you can do is that you can compare the confirmed utility with expected utility. Of course, we know that as long as the confirmed utility is bigger than the expected utility, so we don't go for the risk. So only we go in the situation that if you want to really we want to do something which makes sense. And so we go for the situation that when the expected utility is more than a confirmed utility, then we may consider going for the risky situation. Now, confirmed utility, how to calculate? Of course, the utility function is given, so we put this income into utility function. So that's why it is 10, and then here is, I'll just remove all this. So it's gonna be 4, so is that 20? Then I calculate the expected utility. So expected utility, how it is, it means that we have to put each time, we have to put any of this income into utility function. And of course, we have to multiply it by the probability. So that's why we say that you do remember that you just write like this, that probability of, the probability of 10 I1 plus the probability of 10 I2. So then probability here is 0.6, then 10, I is 44, and then P2 is 0.4, and then I, and then 33. So your friends, they calculated for me, and then the expected utility was 8.5. So now you compare this expected utility here with the confirmed utility here. So you see that expected utility is less than confirmed utility, so that's why she should not take the job. Then the next part of the question is saying that, let's say that for any reason, so I mean, she's supposed to take. So if she's supposed to take, say that she wants to insure herself that the income is insured. So that's why she is ready to pay a risk premium. So how to calculate the risk premium? So fine, to calculate the risk premium, the first step that we have to remember was that we have to calculate the expected salary. Then we put this expected utility into the function to treat the expected utility as confirmed utility. Once we get this income, then the difference between this income and the expected income is the risk premium. So it's exactly what, if I find my papers that I teach you yesterday. Yeah, this is the one that I teach you yesterday, am I right? So you see that first, we calculated this point. You remember this point was the expected wealth or expected income. So this is the average. First, we calculated this. Then we calculated the associated expected utility. That expected utility just now you calculate. So we give this expected utility to the function, to the utility function itself. Then we gain one number. This number is the income associated with that expected utility, which is treated as confirmed utility. And this difference is risk premium. So now we do the same here. That we calculated this number. Now we should do what? The next step that we have to do is that we have to give this to the utility function. This is the utility function. So it means that we have to give it to the utility function. It means that we assume that the expected utility is the confirmed utility. So we assume expected U is confirmed U. So if it's confirmed U, it means that it is, we give it to the function, and then we know that the function was 10i. So once we give it to the function, it means that we put expected utility is this much is equal to 10i. So now I have to get this I from here. How to get I? The easiest way is that I make all with power 2 because I want to remove this. So once I make it power 2, has anybody done that? Is your number similar to my number? Yeah. So I is equal to so it means that we have to divide it by 10, right? So I is 0.442. So this I is which I, if we want to discuss it in the context of yesterday class, previous class, it means that we have given this to the function. So we put it equal to the function. So this is the number we came here. So this is number. Now we need this difference. What is this difference? The difference between this I that we just get and the income, which is the expected income. So the expected income previously we calculated. Here is the expected salary. So this difference is the risk premium. So it means that risk premium is 39 minus 3940. Yeah. And right, great. So now guys, whatever question is coming from risk premium is gonna be like this. So the only difference will be that this function will be different. So now one question, what kind of question is that? Is that objective or subjective? This is objective or subjective? Yesterday we discussed to forget that we discussed about objective and subjective questions. We say that some questions, they have a direct answer, they have very confirm answer, some of the question, no. Yes, so this is objective question, means that the answer is very obvious, is this. So either this or not. If you answer this, you get a mark. You don't answer, you don't get. So this kind of question, you're gonna have 50% of your final is gonna be like this. Okay. So we go to the next question. Which question shall we go? Let me have a look. Maybe we can go for question 2. Question 2. Okay, question 2 again is one of those easy questions that you can easily do. So once I'm summarizing for myself, you do the same as well. You summarize 2. That first is saying that a city is considering how much to spend to hire people to monitor its parking meters. The following information is given to the city manager. Guys, these kind of questions that you see here, once you join the job in the companies, they may ask you to do a lot of this kind of analysis that, hey, for example, this is the cost of something. So we want to know that how we can minimize the cost. So you know that all the companies, all the private companies, they want to minimize the cost. So this is the kind of questions that you see, that this information is given to them. So then say that, okay, then assume that with parking fine, what parking fine would you levy and how many meters monitor would you hire to achieve the current level of deterrence against illegal parking? Okay, so let me explain first to you this. It's saying that they want to make sure that they put a fine for the people who do park in the illegal parking. So then say that the current situation here, this is the current situation that they have 2 monitors. Monitors means that it's a machine that is monitoring, right? So it said that this machine, they have 2 monitors machine and the fine is 20. So now the question is that is this number of the machines are sufficient or not? So if they want to have more of these monitor meters, so of course they're going to cost more, because you can see that hiring each monitor meter costs 10,000 per year. So it means that they have to pay to buy these machines. So now they know that it is not sufficient, and even the this fine is 20, so they cannot catch a lot of illegal parkings. So now say that, okay, I'll give you some more info, and then you tell me that is there any way that with, look at here, that to achieve the current level of deterrence. Current level of deterrence means what? Means that with exactly the same scenario, we want to achieve the same rate of scenario, but maybe we want to consider increasing this, increasing the fine. And it's saying that okay, now this is the question, deterrence to minimize the cost. So it means that the whole thing is here, that we have to give the scenario that is the same deterrence, but it is minimizing the cost. So now we have to see that, okay, let's summarize, maybe we understand something first. Guys, and Zoom has given me a new option. Let me try it now. Guys, look. Oh no. Cancel. So he's saying that the first option, the option is given there in the question, that is saying that hiring 1 monitor, the probability of driving getting ticket each time is 25%. So it means that if we have 1 monitor meter, 1 monitor, so the probability that the drivers, they will receive fine is 0.25. Then it's saying that with 2 monitors, so here is 2 monitors. So the probability of getting driver each time is 0.5. So PR2 is 0.5. With 3 monitors, so it is 3 monitors, then the probability is 0.5. And then with 4 monitors, the probability is 1. So now it's saying that what is the current situation? The current situation is this, that they have fine is 20 and they have 2 monitors. 2 monitors means what? Means how much is the probability? Means that probability with 2 monitors is so the question, read the question again. I will show you again the question. Yeah. The question is saying that what parking fine would you leviate? So it means that they want to change the parking fine. And how many meter monitors would you hire? Now, what is the condition? The condition is that tell us the fine and the number of the monitors. What? We want to have the same deterrence, but we want to minimize the cost. Same deterrence means what? Means that we want to have the expected fine in the same situation. Current level of deterrence. Current level of deterrence, it means that 2 monitor meter and the fine is 20. So then how much is the expected fine? So it means that once we say that the current level of deterrence means that the expected fine here, that was the only key, means that the expected fine should be the same. So the expected fine should be the same, but we want to minimize the cost. Okay, so the first thing that we have to calculate is that we have to calculate the expected fine. They have 2 monitor meters. So it means that there is 50% chance that the drivers, the illegal drivers are caught. If they are caught, they receive the fine of 20. And there is 50% chance that they won't be caught. If they won't be caught, they won't be paying any fine. So that's why the total amount of the expected fine is 10. Exactly, thank you. Now, one by one, we want to discuss about the scenarios. These are the scenario of having 1, 3, or 4. So we want to calculate the expected fine. We want to keep the same expected fine. And we want to see that how much is the fine in different scenarios. So once more, I repeat, we want to keep the same expected fine for all of this. So the expected fine is the same, just calculate that how much will be the fine. So easy. Means like this, that in this scenario, the expected fine is supposed to be 10. Then the probability of getting fine is 25. If they get 25, how much is the fine? And it is 75% that they won't receive any fine. The same goes here. The expected fine is 10. The probability of receiving fine is this much. How much the fine is supposed to be, and the probability of not receiving fine is this. And then finally is the expected fine is equal to 1. That is 4 plus this is 0. So now you tell me, how much is the fine in each scenario? So we write here. increase fine to 40. Okay, do remember we want to minimize the cost. Means yes. So minimize the cost, it means that we want to have only one monitor meter. So it means that to minimize the cost, we prefer to have only 1 meter. So if we want to have only 1 meter, what is this? So we have to just calculate X1. So how much is X1? Exactly. X1 means that 10 divided by 0.25, which is equal to 40. So if we buy 1 monitor, the cost is only 10,000. So if we want to buy any of these monitors, so here the cost will be 30,000. Here the cost will be 40,000. So that's why it doesn't work for us. Whatever is the amount of the fine, I don't care. Maybe you can calculate that how much is each fine. But I know that since we want to minimize, it means that just I want to have 1 monitor. To have 1 monitor, and it says that to keep the same amount of deterrence means that the expected fine is supposed to be 10. So you keep 10 here, and then you calculate X1. So it's going to be 40. That's all. So for example, maybe you can calculate here. If you calculate here, X3 is equal to 30.33, and then if it is like this last scenario, of course, X4 is equal to 10. So you can see that the fine, once we are buying more and more monitors, so the fine is decreasing, but of course we are imposing the charge. So if it's a private company doing that, the private company prefers to buy 1 and then increase the maximum fine. So we did 1 more question, then what else from these easy questions we can do? Let's see what else I can do. Question. Question 5 seems easy again. So far I just did 2, 3, and 4. 5, yeah. 5 again, very easy. You help me. So it's saying that draw a utility function, and it's saying that draw the utility over income. So it means that the vertical axis is utility and the horizontal axis is I. Then describe a man who is a risk lover when his income is low, but risk averse when his income is high. So it means that he wants you to show the relationship between you and I in different attitude towards risk. So this is question 5. So it's saying that you draw, this is the utility over income. So it's saying that draw a person who wants, who initially is risk lover until, for example, until here, this level of income. And then after that, then he's suddenly risk averse because, for example, till here he's young until he earns this much of amount. After that, he's aging like me. So I'm just very prudent nowadays. So that's why I say that if you are a risk averse, so what is the shape of utility function? Do remember that we discussed it in the class utility with respect to I. So do you remember what was the shape? Do you remember yesterday class? Utility with wealth. Now instead of it, we have put income. So this is a risk taker or risk lover. So I'll put the same thing here. Till here. Then after that, this person is risk averse. Means that after that, the shape of the function has to change to this. So that's why I just put it like this. So this is the shape of it. That's all. So if you agree, we do one more question, again easy question, and then we are done until question 5. So we put the rest of the question for next class. Yeah. So we go to question 1. Again, question 1 is that kind of question that it needs a linkage to previous modules. So I hope that you can remember previous modules. Then I want to tell you that whatever we have discussed today, that we are talking about, if you notice, we are talking about different attitudes of the people, or you remember in the example that we were discussing about the stock market and risk-free asset. So we are talking about the preference of the people, that some people they prefer, they behave like the expected market theory. Some people they prefer like segmented market theory. So all of this is about expectation and different behaviors. So that's why totally overall, this kind of topics is consumer behavior. Maybe you can hear it a lot. And nowadays it's very hot in terms of the economics topics are really hot. You can find a lot of papers on that how people they react into different scenarios. And then we want to see that, for example, in different scenarios, that what is the factor which is affecting the people behavior. So in this context, actually lecturing this kind of topics, I want to really lecture it in terms of using the slide is very difficult. I don't know how to explain them honestly. So that's why I try to make it into questions, and then I start answering the question myself. So it's going to be a practice and learning for you. The same goes to this. This actually a question, and this question I got it from your slide. So if you refer to slide, this is available there. But I thought that if I want to explain it from the slide, it's a bit boring, and I don't know actually I can maybe transfer the whole idea or not. So that's why I decided that I will put it in form of the question, and then I discuss between the class. So let's see that. I do the question 1 now. So let's read the question. He's saying that there has been a big snowstorm, and as you stop at the Harvard store to buy a snow shovel, you had expected to pay $50 for the shovel, the price that the store normally charges. So it means that the normal price is $20. So however, you'll find that the store has suddenly raised the price to $40. So although you would expect a price increase because of the storm, you feel that doubling the price is unfair, and the store is trying to take advantage of you. Out of the spite, you do not buy the shovel. So then he's saying that linking this to the fairness concept, you don't need, maybe I can remove that because it makes you more even afraid that what is it? So you can just say that draw the demand curve. So actually some kind of consumer behavior will start with this question. That first of all is what is saying that it's saying that the normal price of something is 20, and you expected that, for example, the price when there is a snow, so the demand for the product will increase. And of course, you know that this increase in demand is the external factor. So it means that it's a shift of the demand curve. So that's why automatically you expect that the higher price. But what will happen is that the price that you see in the market is unexpected. So it means that it is beyond your expectation, it's very high. And you feel that it is very unfair. That's a normal reaction. Most of the time we do that. Although, for example, we want to buy something, once we see that it's very expensive, we say, okay, we don't buy it. So then we want to see that for that kind of products, is it going to affect the change of the demand curve, the shape of the demand curve or not? So let's draw it here. Let's say that this is the demand and this is the quantity. Let's say that this has been the demand function. So demand for shower, right? So this is the shower. Then let's say that we say that we have accepted the price. I just draw something like this, and to say that initially the price has been 20. And let's say that this has been the quantity that the people are buying. Then we know that kind of a snow has happened, so snowfall is going to happen, so that's why the demand curve will shift. Because the demand for this is going to increase. And then of course we expect that the price is going to be high, like this here. So we expect this is something expected. Then what will happen that at the end we notice that the price is not here and the price suddenly has increased to, so the price suddenly has doubled. Then you find it very unfair. So, and then you don't buy. So if you don't buy, so what will happen? Till here, till this is expected, am I right? So it means that if we assume that this is our new curve, am I right? So it means that till here is something that we expect, right? Then what will happen after here? So just I write one sentence. I want you to tell the concept behind my sentence. So I'm saying that with rise in price, the decrease in quantity is higher than the price. So it means that if you say that the price is rising 1 unit, the decrease in quantity is more than this 1 unit. For example, this 2 units. So it means that the rise in price, the decrease in quantity is higher than their price increase. So it means that the unit, what I'm saying that is the quantity of the decrease is more than the quantity of this rise, this price rise. Price has risen. We know that the quantity will decrease. Yes, we know, but the rising price is less. The decrease in quantity is very more. Or I can write it here that quantity will decrease. Decrease in quantity is bigger than the rise in price. Is bigger than the rise in price. So the concept which links the amount of rise in price with the amount of decrease in quantity, the concept which links these together is called great elasticity. So elasticity is talking about that how much the change in price is going to change in quantity. Now, with this scenario here, yes. So we are talking about the elasticity concept here. So now that the price has risen so much and suddenly we decide not to buy. So what does it mean? It means that we had a rise in price, but the reaction towards this rising price has been so much that suddenly the quantity has decreased. So it means that we expect that after here, what will be the elasticity of the function? Do we expect a more elastic or less elastic? So after here, because of the sudden reaction, so rise in price suddenly has decreased the quantity. So it means that it is more elastic. So that's why it is more elastic. So if the function is more elastic, what will happen to the slope of the function? What is the relationship between the slope and elasticity? What is the relationship? No, not the steeper. What is the relationship between the slope and elasticity? Economics and finance student. Relationship between the slope and elasticity is always inverse. So as soon as you see that the function is more elastic, so it means that the slope is less. So do remember, elasticity and slope, they have always negative relationship, inverse. So that's why now that after here, the function, this demand function, now it is more elastic. Now that it is more elastic means that after here, the slope of the function has to change. So if here is the normal function, now the slope of the function has to be less. So that's why I draw this. So this is my new demand curve here. This is my new demand curve. Till here that I expected the rise in income is the normal demand curve. But after here that it is unexpected is the new reaction towards the rising price. You see that the maximum amount that I'm ready, for example, to pay is 38. So I won't buy the 80. So that's why the demand will be broken from here. And we call it kinked demand curve. Means that broken demand curve. So that's all for today.